When you've got the two biggest consumers of oil products actually lifting their demand for oil, we think that that's going to put a very good floor under the oil price.
David Lennox, welcome back to Dukascopy TV. It's a pleasure to receive you again.
Oh, thank you very much for giving me the opportunity to talk to your viewers again on the resources market.
No problem at all. So let's jump straight in then. We're going to take a closer look at oil. Now, Barclays warning that the rebound in oil prices is pretty much over. They've suggested, in fact, that we could see a third quarter track back in prices. Where would you sit on those comments?
Well, look, at the moment, West Texas is currently trading around $45 US a barrel. At this point in time, we haven't changed our year-end range for WTI, which is between about $40 and $50. So you can see the price is sitting somewhere in the middle of our range. So we would suggest that come the third quarter, we won't be seeing a significant fall in the oil price, but then again, we're not looking for a significant rise. So we think that the oil price will track somewhere pretty closely in that $10 range from $40 base up to $50 come the rest of this year.
So let's put those pricing forecasts under the microscope a little bit. Can you expand on that thinking for us?
Yeah, certainly let's look at the supply side first. And there we certainly think that the oil markets, and this has been a problem for the markets now for some time, remains in surplus. That surplus peaked at about 2.5 million barrels towards the latter part of last year. We think at the moment it's probably running at between 0.5 to 1 million barrels. So while there is still a surplus of supply in the market, that does make it very difficult for the oil price to rally. Hence we've kept our $50 top end price range. If we now then look at the demand side, we have seen a couple of things happen. Firstly, the drive season for 2016 in the US has been a very good one. We've seen a significant lift in demand, something like about 4% year on year to, let's say, 10 million barrels of gasoline demand daily. So from that point of view, we think that the US has certainly played a significant part in lifting demand for oil. But then on the other side of the Pacific, we've got China, and they continue to import significant record quantities of oil. So when you've got the two biggest consumers of oil products actually lifting their demand for oil, we think that that's going to put a very good floor under the oil price. Hence we've kept our $40 bottom end of the range. So overall, we think that yes, supply is somewhat being curtailed as the price has weakened over the last couple of years, and demand because of that weakness has lifted, but not enough, we think, to sustain any major movement in the oil price over the remainder of 2016. And that movement is either on the upside or on the downside.
Now, David, I wanted to talk to you not only obviously about oil itself, but also some of those commodity producers such as Rio Tinto, BHP Billiton. In that sort of post-Brexit fallout, we've seen some real falls in terms of their stock prices, not only in terms of concerns regarding domestic growth, but also that exposure to the UK. Now is Brexit really a miners' issue?
Look, when you actually look at Britain leaving the EU, it's not a miners' issue. The concern that the miners will have is the fact that it will have some form of impact possibly on forecast economic growth. By that I mean a couple of things. If perchance when the UK does exit the EU, two things will happen. First of all, we're going to see a transfer of economic activity. That is economic activity is just going to go out of the UK and reposition itself somewhere in the EU. If we see a significant amount of that happening, then really the miners are going to be quite comfortable in terms of their supplying of commodities into those markets. Because they'll do is they'll just shift it from going to the UK to sending it to the EU. So from that point of view, we think that if there's a significant amount of economic transfer between UK and the EU, there's going to be very little disruption to the miners. However, the other scenario is we will actually see economic loss of activity out of the UK. That is where the UK will actually suffer a decline in growth. If that does happen, then that's going to have a ripple effect across the rest of the globe, because you've got to remember the UK is about the 4th biggest economy in its own right. So should it start to contract, then that's going to have a ripple effect across the rest of the world. And of course, global miners are feeding their commodity into that global demand. If that starts to falter, that's really where the concern lay. Not so much that Britain will actually exit the EU, but the ripple effect that will have in terms of the future of economic growth. Should the UK, when the UK actually does exit the EU, it is in fact that amount of economic loss that will be really of concern to miners. And if that is a significant portion, then we're going to see certainly weaker commodity prices over the remainder of 2016.
So if, as suggested, oil bears are sort of back in play, are we likely to see greater investor interest in some of the other commodity plays? I mean, gold, for example, has really seen the benefits from that post-Brexit market, for example.
Oh yes, look, gold certainly benefited because of that safe haven characteristic that we see in gold. When we saw the vote come in, it was an unexpected response that Britain was actually voting to leave the EU. That was completely unexpected and caught the market by surprise. And that instant we saw those numbers being confirmed, you saw the safe haven characteristics of gold coming into play. If you look at oil now and then you look at the other commodities, we don't think that there's going to be any significant shift between investors looking at oil as a commodity and investors looking at the base metals as a commodity. We have, however, seen that shift in gold, primarily, as I said, because of that safe haven. If we're right and the UK leaving the EU only generates significant economic transfer rather than economic loss, then we would expect that we will not see any significant movement of investors trying to determine whether or not base metals are going to benefit from this move or whether or not oil is going to benefit. Overall, however, as you've suggested, the one big commodity that has benefited has been gold. And we do think going forward that scenario of Britain leaving the EU is actually going to fall on the reserve banks or the federal banks or the central banks of this world to actually continue to stimulate economic growth. And that's going to be, we believe, the good tailwind that will drive gold higher. Overall, we expect very little impact because of Britain leaving on oil and very little impact because of Britain leaving the EU on the base metals.
David, always a pleasure. Thank you so much for your insights today.
Thank you very much for having me on again.
David Lennox there from Fat Profits, giving us his insight into the resources sector. That's all we've got time for right now. I'm Natalie MacDonald. I'll be back soon with plenty more exclusive interviews for you. Goodbye for now.